Joining me is Ravi Lambah, who is head of investment groups and head India Temasek, and Vishesh Shrivastav, who is MD Investment India at Temasek. Gentlemen, thank you very much for joining us on BQ Prime. To begin with, Ravi, it's been a volatile few months, and last year has been also a volatile year for many of the businesses going for. If you see whether it's in your portfolio or in globally, how do you see the global investment climate as we sit today?
Cassidy, thank you. Clearly you hit the right chord. It's been a difficult last 6, 7 months globally. We remain very cautious right now in our investment activities. We're looking at the world. There's a lot of uncertainty. There's a lot of issues that need to play out. So, for example, there's the geopolitical impact of what's happening in Ukraine and the geopolitical sort of ongoing U.S.-China sort of trade war that's been happening for some years now. There's the fallout of COVID, which is still not over. There's still a lot of COVID around, and there's still disruption as a consequence of that. And then, of course, then on the economic and the financial side, there's the concept of the inflation in the U.S. and what the Fed's going to do as a consequence of quantitative easing that's been around for a few years now, and now we're moving to a state of quantitative tightening, and how the markets will react to that, and what that means for not just equity markets and debt markets, but overall for the economy at large. And then more closely to India, obviously India has also been affected. There's been funds outflow for several months now, but the domestic demand is still strong, which has been keeping fund money flowing into the market still. But clearly there's an impact of inflation in India as well. So all of these factors combined make us cautious. So we are watching carefully. We are slower on investing. At the same time, we're very actively managing our portfolio, and we're also actively investing, but obviously with a cautious undertone.
Ravi, I haven't seen Temasek been so cautious in the last 15 years as today from your commentary. Do you think that the situation is much more watching for or serious as compared to the great financial crisis which we had, or is that it's happening from multiple areas and handling it is much more tougher than the GFC?
I think it's a very good question. Look, I think there's a lot of things happening right now, which probably did not happen in the GFC. GFC was really a financial crisis. Right now, we have the aftermath of a pandemic, a once in 100-year pandemic, right? And we've seen disruption coming out of that, and there's still disruption, even though we all feel like we are past the difficult part of the pandemic, but we still have to be quite watchful of what the virus does and how it affects not just communities and people and countries and travel and so be it. That's one part. The second part is, in the last 15 years, we've not had a war of this magnitude. There's a war. There's complications out of the war. There's impact on supply chains. There's impact on global food prices, on inflation. There's also impact on oil as a commodity, and then plus there is the sort of fallout of what's happened in the equity markets. And we kind of forget, sometimes that in pre-COVID we were already at the end of what was then a long end of tail of a bull market, right? And then all the funding went in, and central banks came in and put liquidity in the system, and then that kind of drove valuations up. And obviously companies that were sort of digitized and able to take advantage of the COVID world were able to benefit, and obviously those valuations also went up. So there was a sense of a lot of cheap money. Interest rates are very low. Interest rates are going up now. Inflation is going up. So there's a combination of many factors coming in, which makes us cautious. But look, I have to say that once we're cautious, we are very much in business. We've had a very active investment there. We've had a very active few months of investing this year too, and we continue to invest, obviously with a cautious tone.
Vishesh, how do you sum it up for India? Though we are not impacted to that extent by the war and others, but the inflation which is getting imported into the country is impacting. Withdrawal of money from foreign investors is a concern which is there. How do you look at your portfolio in all this scenario?
So look, I think I would say that we are long-term very optimistic on India. The way we look at our investments, we try to invest across themes: digitization, future of consumption, longer lifespan, sustainable living. We find that all of these themes resonate very, very strongly in India. India's demographics, the low levels of penetration across services and goods, the conducive policy environment, all of these, I think, put together, are the reason why India is one of the fastest growing major economies. And I think the other positive I would say is that today the world is facing an episode of inflation which is way out of their control, comfort zones, right? So, for example, in the developed world, 0 to 2% has been traditional inflation, and today they are facing something that is, much, much above that. Whereas we in India have been, over a long period of time, being used to, 4 to 6% inflation, and we are only slightly above that, right? Our policy rates have always been positive, on a real basis. We never had negative real interest rates, and so the delta between the rest of the world, I think, puts us in a good place. But all of this put together, I think the way we look at our portfolio is that we try to construct a resilient portfolio which will give us sustainable long-term returns. And India is, probably, I mean, we are very, very long-term optimistic on India.
How's it been for India for you? You have what, $16 billion in portfolio, direct and indirect. Uh, how much of new investments that you have made? Though you had very good few exits through some of the new age companies in this financial year. What is the kind of entries which you have made?
So look, I think you pointed out right. More than 5% of our overall exposure is is what we have in India today. That translates to roughly $16 billion in US terms. 5 years ago, just to calibrate, this number was roughly about half of that. Every year, consistently on average over a long time frame, we have invested more than $1 billion into India. Last year was particularly active for us, again, both in terms of the new investments we made, as well as the monetization events we had when a lot of our early stage portfolios went public, early stage companies went public, right? So the investment engine in India is working quite well. Even from a partnership engine point of view, we are working with our partners, for example, with Schneider Electric. We've set up a JV that distributes renewable energy in a federated manner. We are working with our platform O2, O2 Power, to set up renewable capacities. We are working with a number of our portfolio companies to enhance the sustainability of each of these. So I think we are working with a number of funds, which both in the impact space as well as in specific areas of focus to act as capital providers across the balance sheet, across the capital structure. And so I would say that the overall health of the India portfolio is quite good, which is again part of the reason which drives our long-term optimism.
What about new age companies? We saw them listing at very good valuation, very high valuation, and then suddenly we had a big correction in most of them. Do you think that you will go back to those old valuations at which the IPOs came in?
So look, I would say that we tend to invest ahead of the curve, earlier, much earlier than they become discovered stories. And we fundamentally believe that an IPO is a step in the life of a company. It's just a step of evolution. It's not a destination. It's not an event where we as investors need to necessarily exit. So I think what we look for and what we strive for is to work closely with our management teams, with our boards, to keep enhancing the operational efficiencies of our companies, to make sure that they keep adhere to the highest standards of governance, the highest standards of responsibility and sustainability. They do the right things at all points in time with their customers, with their employees, with their suppliers, with regulators, with their investors. And market fluctuations will happen. Sometimes you will have valuations go up without reason. Sometimes you will have them fall to what seems like unjustifiably low valuations. But I think since we take a long-term view of things, and we try to construct a resilient portfolio which generates returns for us over the long term, we are able to ride out some of these volatilities. At any point in time, there are always pockets of overvaluation in the market. There are pockets of undervaluation, and and being balance sheet investors, we're able to utilize opportunities both for investing as well as for divesting. So I think
Ravi?
the theme will remain
Yeah.
consistent. We remain very, very optimistic on the early stage portfolio, and we will continue to keep building that.
Ravi, as head of investments group, do you see new age companies going to get the same kind of valuations what it got in the last few years? Is cash flows going to be the new drivers? Is profitability going to be new drivers for valuing these kind of companies?
Yeah, look, I think we've gone through this cycle so many times, right? So you back in the 90s and then early
But
2000s.
we never learned from it, right?
I think we always learn, but the cycle comes back, and then we always become, optimistic, and then we become pessimistic. But look, I think the learning here is simple. That companies that are in the early stage or in the unprofitable stage of their life cycle, in bad times will get more effective than companies that are profitable. Just because they, by definition, need to rely upon equity inflows to fund their business because of the burn, right? If you're profitable, then you can fund your own business with your own cash flow. And I think that is really the gold standard for companies in this environment to get to as close as they can to profitability faster by managing costs better, by using technology and innovation to increase revenues, so that they are then in a position to access the capital markets when they need them, whether it's got to do for M&A or whether it's got to do for expansion, organic expansion. What's happened right now is because valuations have come down, companies are probably have the excesses of the good times where they hired a lot of people or they put on had a lot of marketing burn, etc. Now having to wind that down takes time. And in that process, some businesses adapt faster, some adapt slower. The ones that adapt slower, that are in that problem, will obviously need to go through some kind of, hopefully for them, a short-term crisis, and some may or may not survive. So I think in these situations, it really comes down to the quality of what management is trying to do, the strategy they have. And for us as investors, we look at it and say, well, if you're already invested in a company like this, which is experiencing this kind of stress, then we evaluate and see, go back to our intrinsic value test, look at the fundamentals of the business, look at the management team, look at the business approach and say, well, this business, when it comes out of it, if you were to fund them, they'll come out stronger. So then it's a good thing to fund because, we will all do well. It's a business that's unlikely in that ballpark, which may not get there eventually. Then we have to think hard about how we support them through the crisis. So this is really very company by company specific. I think the aggregate of valuations coming down, the aggregates of valuations coming up, I think is a function of bear market and a bull market. But in all of these environments, we can always find value. We move more to the private side, we can negotiate better as against the public side. And if we get that right, then in the long term, which is where we are focused, we think we'll be okay.
Do you see this pain for startups and new age companies to continue for some time till they reach a equilibrium of managing costs or managing cash flows?
I think again, Sajid, is quite relative and it's quite specific company by company. I'll tell you why. Because companies that have raised capital and have enough of a buffer for the next, say, 18, 24, 36 months, will go through their own process of cost cutting and managing and expansion, and they'll end up okay. Companies that did not raise capital and are unprofitable and are not able to pivot properly will not be able to raise capital easily, and they will have a much more difficult time, which may mean that they'll end up either getting sold to someone who's stronger, right? Or they'll end up reducing their business such that they survive. And some may not survive. So I think it's hard to generalize something like this. And look, we've seen this cycle play out in the US and China, now in India, for many years now. And it really depends company by company. I think at a high level, again, as investors, we have to find value and we have to find good management teams that have the ability to pivot in an environment like this that can then, pull through the business. And that's really where we are focused right now.
Ravi, I was looking at your portfolio and I saw that China's contribution has come down a bit from in the last 2 years. So, it's almost to 22% from what it was a couple of years back. Uh, Is there a reason why you have been reducing China?
I think the consequence of the value that you see is really a consequence of the entire portfolio. So, we've had we have a Singapore portfolio, then we have a China portfolio, US, Europe, and India portfolio in broad terms, right? So in the past year, the China portfolio was more affected by the downturn in the equity markets and a consequence of many actions that happened in China in the technology
Hmm.
space, regulatory
Hmm.
action, which
Hmm.
brought the value of that portfolio down. Yes,
Okay.
we sold some as well, but the main reason was the value came. And then on the Singapore side, it's a very defensive portfolio. We've been spending a lot of time, working with our Singapore portfolio companies to help them transform. And we did that with, Capital Land, for example, one of our companies there. We've been working with Singapore Airlines. We've been working with, other companies, Capital, etc. So we've been working with many of our, and they have seen an increase in value this year.
Hmm.
So there's a little bit of that going on where once the value of a particular region has gone up because of certain actions that the companies have taken. The value of China has gone down because of action that's happened on the regulatory side. The value of the US went up because of the IPOs that happened of the tech companies, right? Which we
Hmm.
did not
Hmm.
fully. And then India, we had a uplift in value because of the IPOs, etc. So it's a combination of all of that. It's nothing to do with where we're reducing or increasing exposure. We've had a very active investment and divestment year, but it's not a consequence. What you talk about the China portfolio is not a consequence of that.
Okay. Vishesh, you spoke about digitization, climate impact investing. Which are the areas where you're seeing a lot of digitization happening in this in our country in India? Uh, any new bets or new investments that you have taken in that area?
So, I think one of the key trends that we see globally is that there is convergence across sectors, right? So, what earlier you would call a pure financial services investment versus a consumer investment versus a translog industrials, right? The beauty about technology is that it's permeating across, right? It's impacting every single sector in many different ways, right? And the nature of companies themselves, right? Now it is hard to tell whether you are a consumer company or a tech platform or a logistics aggregator or all three put together, right? So I think this trend, and this is partly why we kind of moved away from the sectoral silos and into thematic investing, because digitization cuts across sectors, right? And the future of consumption cuts across sectors. Longer lifespans cut across sectors. Sustainable living cuts across sectors. Now, to answer your specific question, the key areas of focus for us, continue to remain, a lot of fintech, a lot of software as a service, a lot of, electrification as a theme, like electric vehicles, services that enhance sustainability, across industries, uh, direct to commerce, both direct to commerce, direct to consumer models, as well as enablers for direct to that enable D2C businesses grow, right? So it remains a very the strategy is made up of many sub strategies, but the unifying theme remains digitization, future of consumer, and so on.
What about climate investing? Have you been aggressively looking at EV and renewable space where you have been able to invest and see opportunities there? Because there's a lot of talk about it in the last 6 months. We have seen two big EV deals happening, valuing the EV companies at more than $9 billion each. Have you seen such kind of opportunities in in India?
So maybe I can talk about India, and then I'll request Ravi to talk about our global
Yeah,
perspective.
yeah.
So there are things we are doing for sustainability. We want to put sustainability at our core, and Ravi will talk about some of the things we are doing internally. But to your specific question on India, yes, we are looking at EVs as a space. We have one small investment. We are looking to enhance the size of that portfolio over time. While it's not fair for me to comment on specific opportunities, but it does remain a core focus area. And not just it has actually three-pronged strategy, right? So one is to invest in green areas, so renewable energy, which is our platform with O2, the Green Next, which is our JV with Schneider, which like I told you, enables distribution of renewable energy in an easier manner, electric vehicles, right? So this is one part of the strategy. The second part of the strategy is to work with our portfolio companies and make them more ESG compliant or more friendly from a climate point of view, right? And there are multiple examples that I can talk about where we are actively engaged with our portfolio companies. The third prong of that strategy is that we have impact funds. We work with partners there who also invest in ESG compliant or impact associated areas. So that's for India, and then maybe Ravi can talk about the global perspective.
Ravi?
Yeah, I think the global perspective tracks quite closely what we're doing in India too. Our sustainability is at our core. We have some years back we implemented an internal charge on carbon to all our investments. It was about, we've now raised that to $50 from about 42. And end of the decade, we're saying we will raise it to $100. So that's an internal, CO2 emission per ton charge that we levy on all our investments. And ultimately, our objective on ESG is a few different ways. One is we are partnering with people to drive, value in our portfolio, also to drive ESG change in our portfolio. Investments that we currently own, we are trying to help them transform into a cleaner, more ESG compliant standard and more compliant environment. We're making sure that whatever capital we put to work going forward is actually compliant with our ESG requirements, and if not, then we just won't do it. We've got a partnership on decarbonization with BlackRock. We found different ventures. We are funding. We're putting capital into impact investing, where there's investing being done with BlackRock, for example, where we're going to try and where the fund's going to try and drive more change in ESG. So I think it's we want to make sure that all our activities at the high level, not only as Temasek, which we already covered, we probably want to get to across that portfolio by 2030. We want to make sure that we're able to drive our investments and our portfolio companies and our thinking to a much cleaner planet. I think that's kind of our focus.
Vishesh, some of the companies like Country Delight that you invested in, or the Hat or Open, Maruti I saw Maruti coming in. I think it's through a public markets that you took up a stake. What prompted you to go for Maruti on one hand, and on the other hand, you are investing aggressively into EVs and other side as well?
So look, I don't think it's appropriate for me to talk about individual companies, but I think all the investments that you will find, in our portfolio will adhere to one of the four themes broadly, right? And and I think Maruti is closely related to the future of consumption, or the increasing growing affluence in the country, where people want safer modes of travel, moving from two-wheelers to four-wheelers. So I think that's what I will leave it at. But I think the bigger picture or the bigger message would be that it would fit in one of the themes that we believe in.
Do you see Maruti to be aggressive to get into the EV mode? Because today, as of today, it's not.
I cannot comment on specific companies. It's an operational decision for the Maruti management team to make. We as shareholders would advocate making the business more sustainable at one point.
Ravi, you mentioned that we were at the tail end of the bull market when we saw central banks increasing capital, liquidity into the market. Do you think that we are entering into a bear phase for the next couple of years? There is a lot of discussion going on that we may be entering into it. Yesterday, if you look at the US inflation that came on Wednesday, that talk about Fed may be more aggressive in raising rates going forward. And if that happens, it's going to have a bigger impact in the way global equities is going to look at that event.
I think it's a great question. It's a hard one for anyone to answer with not having the benefit of foresight. But I think what are we watching for, Sajid? Maybe that's the way I can answer your question. We're watching for Fed action. We're trying to see what kind of action the Fed takes. And clearly the Fed, was behind the curve, and then they sort of, taking certain steps in action to address what has happened in the inflation for a very high inflation environment, which the US has not seen for a long time. In the context, raising rates is one step. We're also watching to see whether the combination of inflation and rate rises, etc., push puts the US into recession. And there's a lot of eyes on that. There's a lot of analysis on that, and that happens. Obviously, that'll have an impact on the equity markets, and that'll have an impact on equity markets in emerging markets too, because that may cause the US also to correct further. And these are all things that we're watching. How it plays out, no one knows. But clearly, there are signs that things are getting worse, at least for the near term, and therefore our stance of being cautious. We're also watching corporate earnings in the US. We're trying to see, when where the earnings are going to come out. The softening is not fully is not a definitive trend yet, but we're seeing it in pockets. In pockets, we're not seeing it. But as if corporate earnings were to correct, as a consequence, of perhaps cost rises because of inflation, supply chain disruptions, etc., then clearly there will be an impact on EPS, and that'll have an impact on valuations too. So multiples may trend down. So a bear market. I mean, if you step back, what is a bear market? A bear market is a market where you see an environment of flat or lower trend. We think that's already here. We think that we got to watch what happens over the next 6-12 months, and the recovery from this will be slow. So whether we move from the current environment to a worse environment or to a better environment, we have to watch. But ultimately, I go back to what we said before. We are cautious. We're very much in business. We're trying to find value in the private space. We're being cautious about public market investments because it's kind of reacts very quickly to what happens. And hopefully we will land up at the end of the year with a portfolio that's even more resilient than it was when we started.
I was looking at your highlights, and you had mentioned in there that volatility has reduced in FY22 over the last couple of years, as a curve has narrowed a bit as well. Do you see that volatility now increasing over the next 6 to 9 months or a year, as we see all those headwinds which you mentioned, whether it's global or domestic in nature?
I think it's entirely likely that we're entering into we will stay in a volatile world, if I can put it that way. Higher or low will really depend upon, at that point in time, what kind of news comes out. If the de-escalation in some of the geopolitical environments, that'll reduce volatility. If commodity oil prices, go the other way, it'll increase volatility. So I think volatility coming down is a consequence of many factors. I don't think it's easy to say that volatility will stay down or will go up. But we are in a volatile world. We're in an uncertain world. We're in a world that is very different, a more polarized world. So I think all of that adds to volatility.
Vishesh, one of the thing about India was the consumption story, but we have seen of late in the last couple of quarters that consumption has also, dipped a bit. Inflation is one of the reasons why it is there. Rural, which was the backbone, has come down. Consumption there has come down. Urban is, is not at the same pace what we saw. Do you see these as some of the challenges for some of your portfolio companies as they expand?
So I think, look, generally speaking, from a longer term point of view, consumption is absolutely one of the drivers for growth for the Indian economy. And there are always, short term blips along the way, or, peaks and troughs. What you've got to remember is that, we are coming out of a 2-year period, which has been unlike, any other period, in recent memory. And so consumption patterns are shifting. There's more digitization happening. The ways consumers engage with companies is changing. We try to take a slightly longer term view of all of this, and are not necessarily bothered too much with with minute fluctuations. As long as the key trends keep playing out, the key decadal trends, if I may even be ambitious to call it that, I think those remain consistent across periods of time. Obviously, this is a volatile time, like Ravi said. This is uncertain time. There will be ups and downs, no questions. But we fundamentally believe that consumption as a key driver of Indian growth will remain so, and that's because of the demographics, because of the low penetration we have for goods and services, because of our policy environment and so on. And those things don't really change, on a very short-term basis. Those things are long-term drivers and will continue to be so.
Have you seen?
If I can just add to what Vishesh said, right? I mean,
Yeah.
why are we so? Why do we continue to be positive on consumption, right? I mean, the digitization shift is very, very real. And that is really driving, higher consumption. I mean, for example, from $46 billion, we're talking about the e-commerce market going to 180 odd billion dollars in 2025. Well, that's a big jump. Digital transactions that are happening, digital payments alone, were sort of, the projections are that they'll triple, from where we are right now in 5 years. We're talking about right now, 2 out of 5 transactions are done digitally, 2 out of 3 will be done in 5 years. So you think about all these things, the efficiency that digitization drives in an economy of this magnitude and scale, right, coupled with what we call innovation across many different businesses driven by technology, right, which is permeating not just financial services, it's permeating logistics, it's permeating agri, it's permeating healthcare services across the board. All of that results in consumption. So yes, we are currently in a phase where consumption may have slowed down because of all the factors that Vishesh and you talked about. But long term, it is hard to see consumption not being a driver of growth in the Indian economy.
Vishesh, have you seen a visible trend of how consumption has disrupted the business models of many of the companies, and whether the companies have been able to, morph themselves into a new business model very quickly to manage that kind of transition?
Of course, I mean we can spend the next 30 minutes or 1 hour or 2 hours talking about.
Okay, if you can take 1 or 2 cases where they have done it.
I'll give you a very simple example, right? So restaurants as a business, has been around for I don't know how many hundreds of years, right? And and till about even a decade ago, you would not think that people would be able to consume sitting in the restaurant food sitting in the comfort of their homes, right? Now, what has that done, right? It has obviously disrupted restaurants, but not in a negative manner, right? Because now restaurants are evolving, and now they're setting up, for example, dark kitchens where you don't need to spend on real estate for your customers to walk in and sit there. You're able to deliver food to them more efficiently than than you could if you had them sitting around and lounging around, using up real estate, which is a fixed cost, right? And it's benefited the platform companies because they've built huge businesses out of aggregating demand for the customer, and they have insights into what what a customer may need at any point in time, and what are ancillary businesses you can build on top of that, right? So that's just one very small example, but this is a just a small example that shows how technology is a win-win-win, right? It's a win for the customer, it leads to more convenience. It's a win for the restaurant because they can expand their reach just outside of physical constraints, and it's a win for the platform because you built a business that didn't exist before, right? And there are multiple examples in healthcare, in financial services, infrastructure. I mean, I could just keep going on.
Ravi, our companies are able to do it on a global scale as well?
Yes, indeed. I think it's a repeating trend. We see it in many different places. I don't think there's any place I don't see it in pretty good scale.
Ravi,
sorry, Sajid, I'm just reminded that we have time for one.
Yeah, I'm just about to say thanks to you, Ravi and Vishesh. It's been a pleasure talking to you. And I think we do it every year. We should increase the the frequency. In my opinion, let's try to catch up much more frequent to get new trends. As you are one of the biggest investors into the country. Thank you very much for joining us on BQ Prime.
Thanks, Ajit. Thank you. We'll certainly catch up. I mean, we can have a more thematic dialogue, I think, off the record.
Yes.
And a little bit more about what we're seeing in blockchain and SaaS companies, the startup ecosystem in India. I think there's a lot of great things happening. So yes, I think we look forward to chatting more. And thanks for taking the time.
Thank you very much, Vishesh and Ravi. Thank you very much.
Thanks, real pleasure.